The coming market shock, how $10,000 gold could mean $500 silver. What if I told you that one of the most critical indicators in the precious metals market is screaming that an asset is profoundly mispriced? It's not a complex derivative or an obscure cryptocurrency, but one of the world's oldest forms of money. We are talking about the relationship between gold and silver. Consider this: for every single ounce of gold pulled from the earth, miners extract approximately 7 ounces of silver. It's a simple geological fact. Yet in the financial markets where these metals are traded, you would need roughly 85 ounces of silver to acquire that same single ounce of gold. This staggering disconnect isn't just a market quirk. It is a profound anomaly that hints at a generational investment opportunity lying in plain sight. This market imbalance is crystallized in what is known as the gold-to-silver ratio, a simple metric that tells us how many ounces of silver it takes to purchase 1 ounce of gold. Today, that ratio hovers in the mid-80s, a level that represents an extreme valuation gap when viewed through the lens of history and fundamental supply. The long-term historical average for this ratio is closer to 60, and at various points, it has dipped dramatically lower. The current elevated level suggests that silver, relative to its monetary sibling, is trading at a significant discount. This isn't just a matter of price, but a reflection of a deep and persistent undervaluation that the market has yet to correct. The core of this problem, and the opportunity it presents, lies in the fundamental differences between how gold and silver are used after they are mined. Gold is, for all intents and purposes, eternal. An estimated 95% of all gold ever mined remains in existence above ground, primarily stored away in vaults, central bank reserves, or adorning individuals as jewelry. It is hoarded and preserved as a pure store of value. It does not get consumed or discarded. This characteristic makes its available supply relatively stable and predictable, as the vast majority of it can, in theory, always come back to the market under the right conditions. Silver, however, lives a dramatically different life. It is a metal with a dual identity, straddling the worlds of monetary history and critical industrial application. While it shares gold's legacy as a safe haven asset, approximately 2/3 of the silver mined each year is consumed by industry. It is a vital component in everything from solar panels and electric vehicles to electronics and medical equipment. Unlike gold, this industrially used silver is often utilized in such small quantities within products that it becomes uneconomical to recycle. It is effectively used up and thrown away, permanently removing it from the global stockpile of available metal. This constant industrial consumption creates a persistent structural deficit in the silver market. Year after year, the world consumes more silver than it mines, steadily drawing down the vast above-ground stockpiles that were built up over decades, many of which were government reserves that are now largely depleted. This is a crucial distinction from gold, where the stockpile consistently grows. For silver, the opposite is true. The available, investable supply is shrinking at the precise moment that its industrial and monetary demand drivers are set to accelerate, creating the perfect storm for a significant price revaluation against its more chemically inert and less industrially critical cousin, gold. The catalyst for closing this valuation gap will likely be a convergence of powerful macroeconomic forces. We are living in an era of unprecedented global debt, rampant currency debasement through persistent deficit spending, and growing geopolitical instability. These factors are steadily eroding public confidence in fiat currencies and traditional financial assets. As this confidence wanes, a global flight to safety will inevitably commence, with capital seeking refuge in tangible, time-tested stores of value. Gold will undoubtedly be a primary beneficiary of this shift, but the truly explosive potential for wealth creation may lie with its undervalued counterpart, silver, as investors awaken to its profound mispricing. This awakening is already beginning in the quiet corners of high finance. Major institutions, which historically have been dismissive of precious metals, are now beginning to publish reports acknowledging the shifting landscape. Analysts at firms like TD Securities and Morgan Stanley are increasingly discussing the merits of holding hard assets as a hedge against systemic risk. There are even suggestions from major investment banks that investors should consider reallocating significant portions of their portfolios away from traditional stocks and bonds and into assets like gold. This represents a seismic shift in mainstream financial thinking, and as this narrative gains traction, it will inevitably draw attention to the glaring valuation disparity between gold and silver. The transition from institutional awareness to a full-blown market repricing will mark the tipping point. This critical phase will be driven by capital flows. Consider the sheer scale of liquid capital available in the United States alone. Over $20 trillion sitting in money market funds, demand deposit accounts, and unused credit lines. This is capital that can be deployed into an asset class almost instantaneously. If a mere 1% of this US-based capital, a conservative $200 billion, were to seek refuge in the silver market, the effect would be cataclysmic for its current price structure. $200 billion searching for a home in physical silver would rapidly expose the market's greatest vulnerability, its limited supply. At a hypothetical price of $45 per ounce, that sum would represent a demand for over 4 billion troy ounces. This level of demand simply cannot be met by the existing liquid, free-floating vault stock, and annual mine production combined. The market would quickly discover that there is not enough physical silver available to satisfy such a surge in investment demand at current prices. The price would have no choice but to adjust dramatically upward to balance the equation, not by a small margin, but by a multiple of its current value. The potential demand is not limited to the United States. It is a global phenomenon. Expanding our view to encompass the entire planet, the pool of capital is vastly larger. The global currency supply, stock markets, and bond markets together represent a staggering $350 trillion. A 1% allocation from this colossal sum equates to $3.5 trillion seeking a safe haven. The numbers become almost too large to comprehend, but they illustrate the sheer force of the monetary wave that could be unleashed upon the precious metals sector, particularly the small and vulnerable physical silver market. The historical precedent for such a dramatic repricing is well established. During the great precious metals bull market that culminated in January 1980, the gold-to-silver ratio collapsed to an astonishing low of 14-1. It is crucial to remember that this occurred during a period when the market dynamics were far less favorable for silver than they are today. Back then, huge government stockpiles of silver existed, there was no structural supply deficit from industrial consumption, and the global debt levels were a mere fraction of what they are now. The current setup is fundamentally far more bullish for a historic rally. The mechanism for this potential price explosion is tied to the structure of the modern precious metals market, which is dominated by paper derivatives traded on exchanges like the COMEX. For every ounce of real, physical silver held in exchange-approved vaults, there can be hundreds of ounces of paper claims trading hands. This is a highly leveraged system that functions smoothly as long as only a few participants demand physical delivery. However, a surge in demand for the real metal would strain this system to its breaking point. This is the scenario where the paper market loses control and price discovery shifts decisively to the physical realm, where scarcity is real and undeniable. The regulators and exchange operators are not passive observers in this dynamic. Their primary tool for tamping down speculative fervor and controlling price volatility is the adjustment of margin requirements on futures contracts. When they raise margin requirements, they force leveraged longs, those betting on a price increase, to either deposit more cash to hold their positions or liquidate a portion of their holdings. This act of forced selling artificially suppresses the price. We are already seeing minor, incremental increases in margin requirements for both gold and silver, a clear signal that the authorities are attempting to manage the building pressure within the system. However, as was demonstrated in the late 1970s, there comes a point where these administrative tools fail. During the final, frantic months of that historic bull market, regulators raised margin requirements repeatedly, issued position limits, and even ordered liquidation-only trading for silver contracts. Despite these unprecedented interventions, they ultimately lost control. The fundamental force of the market, driven by a loss of faith in the currency and a desperate search for a real store of value, overwhelmed their efforts. The conditions are now ripe for a repeat of that scenario, but on a much grander and more global scale. The immediate impact of this tipping point will be a dramatic and rapid compression of the gold-to-silver ratio. As capital floods into the relatively tiny silver market, its price will accelerate at a pace that far outstrips that of gold. A return to the long-term average of 60 to 1 would itself represent a significant outperformance for silver. However, given the unprecedented fundamental backdrop, a move to 40, 30, or even the 20 to 1 level is not only possible but increasingly probable. This ratio compression is the mathematical engine that will power silver's outsized gains during the next major precious metals bull market. To put the potential impact into concrete figures, let's consider a future gold price that many analysts now view as a conservative minimum, $10,000 per ounce. While this may seem high by today's standards, it represents a plausible outcome in a world grappling with a systemic currency crisis. If gold were to reach this level and the gold-to-silver ratio were to contract to a modest 20 to 1, the implied price of silver would be $500 per ounce. This illustrates the incredible leverage that silver currently offers. An investment in silver today is not just a bet on rising precious metals prices, but a highly leveraged bet on the normalization of this historic valuation anomaly. This surge in price is likely to manifest as what is known as a super spike. Most of the time, silver trades primarily based on its industrial supply and demand characteristics. However, during rare moments of intense financial crisis, its monetary nature reasserts itself with a vengeance. During these periods, monetary demand from investors seeking to preserve their purchasing power completely overwhelms the normal industrial market dynamics. The price is driven vertically as a tidal wave of capital chases an insufficient amount of physical metal. This is the moment when silver provides its greatest leverage and potential for wealth generation. After such a dramatic super spike, it is plausible that silver's price would pull back as the initial panic subsides. It might also be the case that a new global monetary system, perhaps one re-anchored to gold, is established to restore order and stability to the world's currencies. In such a scenario, gold's price might be officially pegged, halting its ascent. Silver, having fulfilled its role as the ultimate leverage play during the crisis, could then see its price settle back to a level that is still multiples of its current value, but below its speculative peak, allowing it to return to its primary role as an industrial metal. The aftermath of such a market event would leave a transformed financial landscape. Investors who correctly identified the extreme undervaluation of silver relative to gold and positioned themselves accordingly would realize extraordinary gains. The strategy derived from this analysis is elegantly simple. When the gold-to-silver ratio is historically high, as it is now, one should favor the accumulation of silver. It is the asset that is on sale. This allows an investor to acquire more ounces of real monetary wealth for their capital. The focus should be on accumulating weight, not just chasing the dollar price. The second phase of this strategy involves patiently waiting for the ratio to compress. As the market corrects and the ratio falls to more historically normal, or even low levels, the opportunity arises to convert a portion of the now highly valued silver back into gold. For example, buying silver at an 80 to 1 ratio and trading it for gold at a 40 to 1 ratio effectively doubles the amount of gold you can acquire compared to if you had simply bought gold at the outset. If the ratio drops to 20, that leverage increases to 4 times the amount of gold. This is how one can use market irrationality to methodically build a larger core position in real, lasting wealth. This approach stands in stark contrast to the mindset of many current market participants. Today, with the price of silver languishing relative to gold, investor interest remains a mere trickle. It is reminiscent of the early 2000s, when precious metals were emerging from a 2-decade-long bear market. Back then, one could walk into a coin shop and be the only customer for hours, acquiring silver for less than $5 an ounce. The sentiment was bearish and the opportunity was immense. Today, even with prices significantly higher, the general investor psychology feels remarkably similar, apathetic and uninterested, which are often the hallmarks of a market bottom. This apathy will not last. The catalyst for change will be the relentless drumbeat of news coverage. As silver's price begins to stir and eventually breaks out to new highs, the financial media will be forced to cover the story. At first, it will be a monthly curiosity, then a weekly feature, and finally a daily headline. This constant exposure will attract a new wave of investors who were previously unaware of the opportunity. This is the flood of mainstream participation that is required to ignite the final, most powerful stage of the price super spike, transforming silver from an obscure industrial metal back into a premier safe haven asset in the public consciousness. We must not be so myopic as to view this as a purely domestic issue. The forces of currency debasement and the search for a reliable store of value are global in nature. The stockpiles of available gold and silver are global, and the pool of potential buyers extends to every corner of the planet, where individuals are seeking to protect their savings from the ravages of inflation and government mismanagement. The coming rush into hard assets will not be confined to a single country. It will be a worldwide phenomenon, adding an entirely new dimension of demand that was not present in previous bull markets. The current market environment represents a rare confluence of factors: a historical valuation anomaly in the gold-to-silver ratio, a growing structural supply deficit in the physical silver market, an unprecedented global debt and currency crisis, and the dawn of mainstream awareness. Each of these elements on its own would be a powerful driver for higher prices. Occurring together, they create the potential for a market repricing event that will be remembered for generations. The opportunity is not in predicting the exact timing of this event, but in recognizing the profound imbalance and positioning oneself before the rest of the market awakens. The takeaway lesson from this deep dive into the dynamics of the precious metals market is that fundamentals ultimately matter. While sentiment, paper market manipulation, and momentum can drive prices in the short term, they cannot defy the laws of supply and demand indefinitely. The chasm between silver's geological and industrial reality and its current financial market valuation is a fundamental imbalance of epic proportions. History teaches us that such gaps do not persist forever. When they do correct, the movement is often swift, violent, and life-changing for those who were positioned on the right side of the trade. Therefore, the intelligent allocation of capital today should be dictated by this glaring disparity. Why would an investor choose to purchase the relatively expensive asset when the undervalued one offers so much more potential leverage? The ratio itself provides the clearest signal. A high ratio implores us to accumulate silver. A low ratio will one day signal the time to shift that wealth back into gold. By letting this simple, powerful metric guide our decisions, we can remove emotion from the equation and instead operate based on a strategy grounded in logic, history, and the unassailable fundamentals of the physical world. The narrative that silver is merely gold's poorer cousin, a volatile industrial commodity, is a dangerous misconception in the current economic climate. It is, in fact, a coiled spring. The industrial demand provides a solid and growing base, while the monetary demand represents the explosive, asymmetric potential. As the global financial system becomes increasingly fragile, silver's monetary characteristics will come to the forefront. Its historical role as money for the common person will be rediscovered, and the rush to acquire it will be driven by the most powerful human emotion of all: the desire for self-preservation in the face of uncertainty. Let us be clear about the stakes involved. The prediction of $10,000 gold is not a sensationalist fantasy. It is a sober calculation based on the trajectory of global debt and monetary expansion. In such a world, $500 silver, derived from a historically plausible 20-to-1 ratio, is an equally logical outcome. The journey from today's prices to those future valuations will be volatile, but the destination appears to be a near certainty. The key is to see the opportunity now, while the market is still quiet and the asset is still profoundly mispriced, before the coming flood of capital changes the equation forever. We stand at a unique crossroads in financial history. The decades-long experiment with purely fiat currencies is showing undeniable signs of failure. The accumulated imbalances are reaching a breaking point. In this environment, tangible assets with no counterparty risk will once again resume their rightful place at the center of the financial system. Gold will provide the stability, but silver will provide the explosive leverage. The current 85-to-1 ratio is a historical aberration, a gift to those who understand its implications, and a clear signal that silver is the bargain of a lifetime. The final lesson is one of conviction and patience. The forces arrayed to maintain the current status quo, including the paper market mechanisms on the commodities exchanges, are formidable. They may succeed in suppressing prices for longer than many expect. However, they cannot create more physical silver out of thin air, nor can they halt the erosion of confidence in the global currency regime. The fundamental case is set in stone. For investors who can look past the short-term noise and focus on the long-term, unassailable fundamentals, the opportunity to capitalize on this historic repricing of silver is here and now.